Earnest money is a deposit a buyer offers to show serious intent after a seller accepts an offer. It is not an extra fee simply handed to the seller at the start. It usually sits in escrow while the deal moves toward closing. Earnest money is a buyer's deposit that shows serious intent after an offer is accepted. A buyer offering nothing may look less committed than a buyer placing a meaningful deposit. The deposit tells the seller the buyer is willing to put money at risk under the contract terms. The amount becomes part of the seller's confidence. It is usually held by an escrow company, title company, broker, or attorney rather than paid directly to the seller. Earnest money is usually credited toward the purchase if the deal closes. In everyday life, it may reduce what the buyer needs to bring later for down payment or closing costs. Buyers should still confirm how the credit appears on the closing statement. The amount varies by market, property price, and negotiation strength. The amount varies by market. Local custom matters. In some areas it may be a small flat amount. In competitive markets it may be 1 to 3% of the purchase price or more. A larger deposit can make an offer look stronger, but it also increases the money at risk if the buyer breaks the contract. If several buyers want the same home, a stronger earnest money deposit may help an offer look safer. The seller sees more commitment behind the paperwork. Competition can push the deposit higher. Contingencies decide when the deposit can be refunded and when it may be forfeited. A larger deposit is not automatically better. If the buyer misses deadlines or breaks the contract without protection, more money could be at risk. That is why strength should be balanced with safety. Earnest money is serious because it is tied to deadlines and contingencies. The contract decides the rules. Contingencies protect the buyer in specific situations. Inspection, financing, appraisal, or title problems may allow the buyer to cancel and recover the deposit if deadlines are followed. Inspection, financing, appraisal, and title deadlines should be read carefully before sending money. Missing a deadline can be expensive. A buyer who waits too long to object after inspection or financing trouble may lose protection. Earnest money depends on timing as much as intent. A buyer should know who holds the deposit before sending funds. A title company, escrow company, broker, or attorney may hold it depending on the location. Escrow keeps the money from being casually controlled by either side. The holder should be named clearly. Earnest money is not an extra fee if the deal closes. It normally applies toward the buyer's purchase costs. Buyers should never send earnest money outside the official process. Payment details should be verified through trusted channels. Wire fraud and fake payment instructions can target real estate transactions. The deposit is useful only when the buyer understands the contract rules attached to it. The deposit can become disputed if the deal falls apart. The buyer may believe they canceled properly, while the seller may believe the buyer defaulted. Written timelines and notices become very important. The amount should be strong enough for the offer but not careless for the buyer's budget. A buyer with real money deposited is less likely to disappear without consequence. The deposit gives the seller some protection after taking the home off the market. Sellers like earnest money because it reduces casual offers. Earnest money is useful when it signals commitment without exposing the buyer to risks they do not understand. Buyers should choose an amount they can afford to have tied up. Even if the deposit is refundable under certain conditions, the money may not be instantly available during a dispute. Liquidity matters. Refund rules depend on the contract, not on verbal comfort. They may connect at closing, but they are not the same thing. The down payment is part of the financing structure. Earnest money is a contract deposit showing commitment. Earnest money is different from the down payment. Inspection and financing dates decide when the buyer can still walk away safely. It is also different from option money in places that use option periods. Local rules can change the details. Option money may buy the buyer time to inspect and cancel, while earnest money supports the purchase contract. A missed deadline can change a refundable deposit into money at risk. A reasonable deposit, clean documentation, pre-approval, and realistic timelines can work together. A buyer can strengthen an offer without risking everything. Earnest money is one part of the offer package. Earnest money is serious because it is tied to deadlines and contingencies. The safest approach is to read the refund conditions before signing. Know exactly what happens after inspection, loan denial, low appraisal, title issue, or buyer default. Do not rely on a verbal summary. The deposit becomes less scary when the buyer understands each contingency date. Escrow holders usually need instructions, agreement, or legal process. A seller should also understand release rules. The money may not automatically transfer to the seller just because the buyer cancels. A buyer should know who holds the deposit before sending funds. How much you need depends on price, local custom, competition, and risk tolerance. A buyer in a calm market may need less than a buyer competing for a desirable home. The right number supports the offer without creating careless exposure. Earnest money is a signal of commitment, but the contract controls the outcome. Used wisely, it can make an offer stronger. Used carelessly, it can put real cash at risk. Earnest money is a signal of seriousness backed by contract rules. The deposit should always match both the market and the buyer's comfort with the contract. Before acting on earnest money, connect the offer to the written deal. Before acting on earnest money, connect the seller to the written deal. Before acting on earnest money, connect the buyer to the written deal. Before acting on earnest money, connect the contract to the written deal. The amount should be strong enough for the offer but not careless for the buyer's budget. Earnest money should never be treated as a casual transfer. Before sending it, the buyer should know who holds it, which deadlines protect it, and what actions could put it at risk. The deposit can strengthen an offer, but only when the buyer understands the contract behind the signal. The right earnest money amount depends on local custom and personal risk tolerance. In a competitive market, a stronger deposit may help the offer stand out. In a risky deal, the buyer may need more protection. The number should match both the market and the buyer's confidence in completing the purchase. Buyers should also avoid sending earnest money outside the official process. Wire instructions, escrow details, and deadlines should be verified carefully. Fraud and confusion can turn a normal deposit into a serious problem. The money should move only through the trusted path named in the transaction documents. Sellers like earnest money because it discourages casual offers. Buyers should respect that purpose while still protecting themselves through the contract. The right deposit says the buyer is serious, but it does not require ignoring inspection, financing, or title risks.